In this short video, we're going to talk a little bit about if your customers can qualify for an actual business loan and how to know quickly if your customers will qualify for a business loan, even get an idea of the kind of business loan they may qualify for. Look, the benefit of business credit is that it works for any type of business. They don't need to have any cash flow. They don't need to have collateral. They don't need to have good personal credit. Even as a startup, any company can build business credit. That's what's beautiful about business credit is that it's a catch-all. Anybody can qualify for business credit, but a business loan, somebody has to meet some kind of qualifying criteria. So even though all your customers can get business credit through the Finance Suite, some of your customers are also able to get business loans, business credit lines. So what does it take to actually qualify for a business loan? Well, I call that the 3 C's of lending. There's a 3-step formula to simply decide whether or not your customers will qualify for financing or whether or not they will not qualify for financing. And the first C, the first step to check is, do they have cash flow? Do they have cash flow monthly coming into their business of $10,000 or more? And have they been in business 1 year or more? If they've been in business 1 year or longer and have cash flow of about $10,000 or more, then that means they could typically qualify for some kind of cash flow based financing. Maybe it's revenue lending. Maybe it's a merchant advance. Maybe it's an actual alternative SBA loan or venture capital. There's a lot of different options if they have verifiable cash flow. Okay, whether they have good credit, whether they have bad credit, even if they have no collateral, there's definitely financing options available if they have the one strength of consistent cash flow. If they have cash flow of $10,000 a month or more in 1 year in business, then they do preliminarily qualify for some type of cash flow based financing. Now, of course, there are specifics to determine if they will get denied or not. For example, how do they manage their bank account? Do they have a bunch of overdrafts? Are they negative at the end of each month with their balances? So there are definitely variables that in other videos will drill down to get into more specific approval criteria. But on the surface, if somebody has cash flow of $10,000 a month or more 1 year in business, then they can preliminary qualify for cash flow financing. Another type of financing is credit-based financing. This is unsecured financing. This works for startup companies because they don't need to verify cash flow. They don't need to have any kind of collateral. So even if they have zero cash flow or can't verify that they have cash flow, and even if they have no collateral, they can get up to $150,000 in unsecured financing. And the best part is that a lot of this financing offers 0% rates for the first 6 to 18 months. So they can get very low interest financing if they have good credit, or a partner, a credit partner, a guarantor, whether it's a family member, a friend, or somebody already involved in the business. If they have good credit or they have a guarantor that does, that opens up unsecured financing programs. Or maybe they have collateral, some type of legitimate business collateral. It could be account receivables or purchase orders. It could be equipment or inventory. It could be stocks or bonds or a 401k on the personal side. It could be commercial real estate. If they have, it could be a book of business if they're an insurance agent. If they have some kind of viable business collateral, there's a lot of collateral-based specific loan programs that work for them just based on that strength. They have real estate, we can get a commercial real estate financing and borrow against the real estate they have. They have equipment they own free and clear, we can borrow against that with equipment financing, or get them a large credit line using their inventory as collateral. Or again, maybe they even have on the personal side a 401k or stocks. Those also open up loan and credit line options for them. And again, the benefit of collateral-based financing is they don't need to have good credit. Credit doesn't even matter. And they don't need to have consistent cash flow. So this is the 3 C's of lending. Does your customer have one of the three? They don't need all three. That's what's beautiful about the Finance Suite. A conventional bank would require all three of these to get a business loan. A lot of people don't have all three. That's why they can't walk into a bank to get a loan. But with the Finance Suite, they only need one strength to actually get a business loan. Whether that's consistent cash flow, whether that's good credit or a good credit partner, or whether that's collateral, doesn't make a difference. All that matters is, do they have one of these C's, cash flow, credit, or collateral? If they have one of the three, then chances are good they can qualify for a business loan. And then you can simply use the finance qualifier part of your back office where you click on add clients, click on finance qualifier to enter their information in there, and you can take a deeper look to make make sure that they actually will qualify. But what does it take to preliminary qualify a customer? Simple. Do they have cash flow? Do they have credit? Or do they have collateral? The 3 C's of lending. If they have one of these three, then there's a good chance they can secure a business loan through the finance suite or through the direct funding program.